choosing the right funds for retirement can feel overwhelming. When your employer offers a list of four 01k options, it's not always clear how they differ. Which one actually helps your portfolio the most? With so many investment funds available, it's easy to feel lost before you even start. A lot of people don't want to become investment experts. They're simply looking for something reliable that can deliver solid returns over time. They don't want to spend hours researching charts and fund reports. What they want is stability paired with growth, so they can move closer to their long-term goals. One of the most widely used funds is probably one you've already heard about, the S&P 500 Index Fund. It's often used as a benchmark for how the US stock market is doing overall. But what exactly is the S&P 500 Index Fund, and does it make sense for your money? Let's break down what it is and whether it deserves a spot in your portfolio. My name is Jake, and I help people learn about money, personal finance, and investing. If you want to build a stronger financial future, subscribe to the channel and hit the like button if this video adds value for you. An index is simply a tool used to measure how a portion of the market is performing. The S&P 500 tracks the performance of 500 of the largest publicly traded companies, similar to how the Dow Jones Industrial Average follows 30 major blue chip stocks. Since the S&P 500 represents about 80% of the total market value, it's often viewed as the best overall snapshot of the stock market. That means when you invest in this index fund, your results will closely match this segment of the market, not better, not worse. That's an important point. Index funds are designed for passive investing. They're a type of mutual fund that isn't run by managers trying to outperform the market. Instead, they're built to copy the performance of an index, like the S&P 500. Because of this hands-off approach, the costs are extremely low. For instance, a Vanguard S&P 500 index fund charges about 0.03%, or $300 per year for every $1 million invested. So, how does the S&P 500 index fund actually work? It's straightforward. When you invest, you own small pieces of all 500 large companies in the index. As the index changes over time, with companies added or removed, the fund automatically adjusts to match it. Another key benefit is diversification. The S&P 500 spreads investments across 11 major sectors, with no single sector making up more than 30% of the total. This helps reduce risk, especially compared to funds that are heavily concentrated in just one or two industries. This setup gives investors instant exposure to a broad section of the market without needing to do much research. Let's look at how those sectors break down. Technology is the largest, making up roughly 27% of the index. That's a significant share, but technology continues to grow and influence nearly every part of modern life. Next is healthcare at about 14%, including companies like United Health Group, Bristol Myers Squibb, and Amgen. Consumer discretionary comes in third at around 10%, with familiar names like Netflix, Disney, and Starbucks. The fourth largest sector is communication services, which includes companies such as Verizon, Cisco, and AT&T. Financials follow next, with firms like PayPal, Bank of America, and Wells Fargo. Industrials come in sixth, including companies like Caterpillar, Boeing, and 3M. Seventh is consumer staples, featuring brands such as Procter & Gamble, Costco, and CVS. The eighth sector is utilities, with companies like American Electric Power Company, Emerson Electric, and Eversource. Real estate ranks ninth, including businesses like Crown Castle International, Public Storage, and Welltower. 10th is energy, with companies such as Marathon and Valero. Finally, materials round out the list, covering businesses that produce metals, chemicals, and construction supplies. You'll recognize many of the biggest names in the S&P 500. Companies like Apple, Google, Amazon, Berkshire Hathaway, Facebook, Johnson & Johnson, Microsoft, Procter & Gamble, and Visa. Together, the top 10 companies account for more than 25% of the index's total movement and returns. So even though the index holds 500 companies, they're not weighted equally. A small group of massive companies has a much bigger influence. One major strength of the S&P 500 is that companies must meet strict standards to be included. Before a stock is added, it's reviewed by the US Index Committee to ensure it meets specific financial requirements. To qualify, a company must be based in the US, have a market value of at least $8.2 billion, be highly liquid, have at least 50% of its shares available to the public, and report positive earnings in its most recent quarter. The stock must also trade at a reasonable price and have been publicly available for at least a year. So, should you invest in an S&P 500 index fund? Before answering that, it's important to weigh the advantages and disadvantages of index funds. Since index funds are passively managed and simply follow the market, their fees are extremely low, which is a big draw for many investors. And as mentioned, they offer solid diversification. But where the S&P 500 and other index funds can fall short is in their potential rate of return. If you're comfortable earning an average market return, this can be an excellent investment. It delivers most, if not all, of what's needed for a solid, well-rounded portfolio. That said, many investors aim a bit higher. They want returns that beat the market over time, not simply track it, and that's where growth-focused funds come into play. If your goal is to outperform the market, it can be done with a well-structured growth stock fund. This doesn't require picking individual stocks or trying to time market moves. Some growth funds are built by selecting the fastest growing companies directly from the S&P 500 itself. With a fund like that, you still benefit from diversification and established companies, but your money is concentrated in the strongest growers. For example, Vanguard's S&P 500 Growth Fund holds 283 growth stocks taken from the index. Over half of its allocation is in technology, which creates strong upside potential, but also slightly more risk. You're still invested across all the major sectors found in the index. However, slower growing areas like utilities, real estate, and financials make up a smaller portion. From 2009 to 2019, the S&P 500 returned just under 14% annually. That's solid, especially during a long bull market, but it lagged behind growth-focused funds. Even in a strong year like 2019, the S&P 500 returned a little over 31%. Meanwhile, top performing growth funds delivered returns above 40%. While aggressive growth funds tend to drop more during bear markets, their long-term performance is typically stronger. Over time, even a few percentage points can create a significant gap in total growth. Some funds do worse than the S&P 500, and those are usually best avoided. But there are plenty of options that consistently outperform the index while still keeping risk at a reasonable level. As always, the right investment depends on your age, available capital, retirement timeline, and several other personal factors. That said, the S&P 500 remained a strong option for investors who are new, unsure where to start, or simply want a reliable place to invest their money. And if you're investing for the long haul, leaning slightly more aggressive can make sense, as long as your portfolio stays well diversified across companies and sectors.